Welcome to Harbor Rock Wealth Management's Planning Tip. My name is Ruben Smith, and as always, I'm joined by my good friend and partner, Jimmy Lester. Welcome.
6 foot, 225. Bing!
And going up.
So, so here's the thing. Last tip, I said I'm going to do this every single time now, and it's from one of our favorite radio hosts, sports guys,
Iconic, Dan Patrick.
Dan Patrick.
Right.
We've both watched and listened to that for years, and I always think it's funny when people do that. And the reason I say 6 foot now, I've always been, all throughout my sports career, 5'11" and high change. And this time, a recent insurance application I put in, she did the measurement, and she said, I got you at 6 feet. And that made me feel like I was 6'5". So, so finally, 6'5", 225 as of this morning.
Bing. And that significantly changes your BMI too. So congratulations.
I think she liked me. She was trying to help. I think she was trying to help me out. So I don't know.
She looked at your attire for the day.
Sure.
Let's knock, I don't know,
She
10
took
pounds.
2 steps back and she said, 6 foot. That's good. So anyway, glad to be here for another great topic we're going to discuss today.
Yeah, so I think you and I have been talking about the podcast for a while and talking about what are we doing with it. It's now been in effect for over 3 years. We have almost 100 pieces of content, which is really cool.
Yeah.
And we decided part of that conversation was, are we going to continue to do it? Are we going to put some more effort into it? What do we want to do with it? Yeah. So I think we've decided to put some more effort into it. So we've come up with 30 shows or pieces of content for these planning tips. So we're going to try and put 1 or 2 of these out a week and go from there
until we're told to stop or
until let's say until our clientele or markets or something disrupts us to where we need to focus the bulk of our attention or our free time, I should say, back on clients, which is absolutely our priority.
Yeah, and we have a good time doing it, but again, we position it as a different medium or way to see or hear content that a lot of it we discuss. A lot of it sounds familiar. A lot of our consistent reviews, service models, this information is presented in some way, shape, or form, a lot of these topics. So some of this might sound familiar at times, but that's intentional. We want to reiterate and press home important pieces of information and topics that are relevant to clients who the shows are for. So.
Exactly. And a lot of the content that we do comes from our client conversations.
Yep.
So, and I think this is a good example. So today's topic is going to be is interest rates, and are interest rates staying higher for longer? Short answer, yes. I mean, yes.
It sure seems like it. Yeah.
Here's what's working against us, and if we go back to the beginning of the year, I think the idea and markets had certainly priced in 2, maybe even 3 rate cuts this year. Something that's working against it is inflation. Okay, inflation peaked up recently as a result of the conflict in the Middle East, and I think we're all seeing it at the gas pump. Even though, as of the taping of the show, it sounds like there might be some resolution with a meeting going on in Europe.
It's a liquid situation.
Fluid, yeah. So oil prices are up, inflation is up. There's some inflationary concern.
Yeah.
Okay. The Fed is not going to lower rates in inflationary times. The reason being that's adding fuel to the inflation fire. That makes no sense economically. The other thing that's working against us and for us at the same time is that the economy is still strong. Yes, I know inflation's creeping up and unemployment is starting to, concern some people. But even with unemployment between 4 and 4.5%, that's still historically low and deemed full employment. So you look at corporate earnings over the last 3 quarters; they've been breaking records. The economy is strong. I don't. When you look at it as a whole, there are pockets that are starting to show some weakness, but it's still doing really well. So, is the Fed going to lower rates in times of inflation? No. Is the Fed going to lower rates when the economy is strong? No.
Yeah,
So
what's the
there's
exactly?
your answer. I think rates, unfortunately, for some of us, are going to stay higher, higher for longer. And I say some of us because I'm one of those that bought a house in the last 12 months, and my mortgage rate is higher than I would like it. But
Yep.
you know, it'll come down at some point, and I will have an opportunity to refinance at some point,
Yeah.
but maybe
So
not in the next 6 months.
right, right. It's going to happen. We don't know when. And when I hear our interest rate's going to stay higher, are we talking about yield? Are we talking about return? Or are we talking about borrowing rates or both? Or
Yes.
what's
Let
the
me.
correlation? Because some people might be like, well, no, I want a better return on my money at the bank, or
Well, it's all relative, right? So in some cases, it can hurt people if you're talking about borrowing costs, right? But in some cases, if you live in that fixed income CD FDIC world, maybe it's a win for you, right? Because now,
depends on what your need is at that time.
yeah, because your CD rates can pay higher, money
Right.
market accounts can pay higher.
I remember that back in like the '80s, people that, reference the '80s or great times. So I remember when I was getting 12% on a savings account. Well, you were also paying 16% on a mortgage or something.
Oh,
Or,
exactly.
it's
Yeah,
just, it's funny to hear.
it's all relative. So, I think interest rates, certainly it can impact any part or in large part many aspects of your retirement plan, whether it's like we talked about borrowing costs with mortgages.
Yeah. Yeah. Yeah.
What is your cash earning? What are your bond yields? It can impact all of that. Um, do I think higher rates for a longer period of time could eventually impact some things? Yeah, I think it eventually could impact the equity market, especially if rates stay higher. Then you have corporate America. Their borrowing costs are going to be higher. That could eventually impact their valuation and bottom line.
Yep.
I just think for the most part, I think it's higher rates aren't necessarily a positive for our clients. And the reason why I say that is not only from a borrowing cost standpoint, but most of our clients do have a majority of their assets exposed to equities, to the stock market. So I think long term, higher rates, staying longer, it can be a negative.
A little more
for
pressure.
clients. The minority of our clients are ultra conservative, and to each their own, but they love environments like this where CDs are paying and money markets are paying and
Right.
treasuries are high. So
Yeah. So what do we do? What do people do?
what
What's,
is,
what do they do in this environment? Can I say they should talk to your financial professionals?
oh, there you go. That's a good plug.
I was leading you to that one.
Thank you. Yeah, I think you just make sure that whoever your financial planner is, that your financial plan has been stress tested and is able to navigate any interest rate environment, right? The asset allocation will follow suit based off where we're at with interest rates. Maybe we extend duration, shorten duration in the bond side, or we identify maybe some more interest rate sectors of the stock market to either participate in or steer away from, depending on what's going on with interest rates as well. Um, I think one thing that we gotta be careful of too is assuming that what you're earning on cash. It's very easy to see these online offerings, these online bank offerings, or even money markets paying well above 3%. I think we got to make sure that clients cannot rely on that forever.
Get
So
starstruck on a rate,
yeah, I mean, maybe for the next year or so, sure, we can rely on some pretty decent cash returns. But I think at some point that's gonna taper off, especially as rates come down.
So it's not necessarily the rate environment that should be driving your next move or no move. It's really what your needs are in retirement, pre-retirement, being and having a plan that can be fluid and nimble in any environment, as you were saying before. It's don't get stuck on the rate.
Well, yeah, going back to the planning piece, is your plan success determined on the next 12 months? No, it's determined off the next several decades.
Yeah,
Right.
we don't know. We definitely don't know beyond that. I mean,
Sure. That's why regular visits, regular check-ins,
There you go.
regular updates with your plan, with your advisor, stress testing your portfolio, stress testing your expenses,
yep.
and making sure that these Monte Carlo analysis that we run that you're going to be able to withstand whatever life as well as economic markets, market events are thrown our way.
Yeah,
So
that's awesome.
but yeah, I think rates will stay higher for longer. I don't necessarily think it's going to be a bad thing. Obviously, if rates stay in the way they're at right now for the next decade, I think you could have some downward pressure on equities. But we're not overly concerned, even though it may be a bit uncomfortable for people like me with a higher mortgage than they want to pay.
Yeah, exactly.
But
Yeah.
and I think it's worth noting on that with these shows, it's when and how we, I guess, participate with our clients. It's not about finding perfection. It's about finding, I guess, being nimble and being able to stay fluid and liquid with the client's plan and making sure that they're able to withstand most any, if not all, market situations. So stress test, run it through the plan, and from there we'll pivot as needed.
Yeah, I think it's it reminds me of how often we hear, especially after working with clients over years of time, and having these regular meetings in our service model and these reviews. So many of them now, after we digest their specifics goings on at that time, you guys you'll let me know if I need to do something, right? And it doesn't mean they're just ignoring their accounts or just saying, well, I blindly trust you. That's not what it's the opposite. Because that regular management of your plan and your situation ensures that you can wake up feeling good and not see a headline that scares you or a ticker that scares you or something of that nature.
Yeah, we've had two clients in particular this week have paid us, I think, what is the greatest compliment is that they no longer have to worry about this. They don't stress about this anymore in their day-to-day life.
Yes.
And I think that's the biggest compliment, because that shows that we've earned their ultimate trust.
Huge.
So,
yes.
And we don't take that lightly. I mean, we expect to earn that with every client and continue to earn that on an ongoing basis.
No, that hits heavy. I love when I hear that.
Yeah,
never gets. It's huge every time. It takes that makes me a little emotional. Thank you.
Yep, absolutely, absolutely. So, this world is constantly changing, and we're here to navigate and help navigate clients through these choppy waters at times, and there will be smooth sailing again.
Yes,
it will happen, and that's typically in portfolios or with portfolios where we will dial up risk or encourage them to take a little bit more risk. But
good stuff.
Yeah, well, this is fun. We'll be back in the seat again soon, I'm sure.
Yep.
And
Sounds good.
We appreciate you all tuning in. We'll catch up with you soon.